And I'm going to mute everybody. Yes, I want to mute all. Oh, hang on. I need to unmute Kurt. And I probably should unmute Pete, although I don't know. It's maybe we won't unmute Pete today.
I'm enjoying this level of power.
I know, that's what I was thinking too. Okay, Pete's back. All right, so as you guys know, if you've been here before, we're going to start off with a little thing first in terms of here's the dynamics and everything else. Pete's going to do a summary of what's gone on in the last couple of weeks, and then Kurt's going to go forward in terms of bonds. So let me share this, share, and do this again. There you go. Okay. And I need to do something here for just a moment because I need to let in whoever's over here. I will do that. And then I'll get rid of this. Okay. So we're in week 6. We're going to talk, it's your money. We're going to talk about fixed income investing, how to use bonds. Kurt's going to do that in just a minute. First hour. If you remember, we're going to leave videos off, and we're going to stay on unmute so we don't have an issue in terms of what people are going to do, you know, in the video, because it can only be the 3 of us. So we're going to be doing that. Up in the upper right-hand corner, you can go to full screen. If you want to be where it says gallery view, then it may be easier for you to see us. You can click back and forth and see what works best for you. As we've done in the past, if you want to send us a message, because I'm going to be monitoring those, you click on chat, up pops this box, you type what you want, hit enter, and it comes to me and I'll read them and I will ask Kurt, Pete, whatever, what the questions are as we go along and see how those best fit in. As before, if you go to itsyourmoneyandestate.org, that's the website for the group. If you click on the sessions, It's Your Money, go to which week you want to be, then you can go through and look at which one of the sessions you want to look at either somewhere in that session. We don't know exactly where in that section. We don't know where it's going to be. Will be a video of this after probably early next week, as well as the handout material. So all of that is available to you here. So we're in week 6 at the moment. We're doing bonds. We've gone through mutual funds and all the other things. Pete will talk about that in just a minute. Next week, we're going to do stocks. And then it's what on earth is our mind doing to ourselves? So that's where we are. Take it, Pete.
Okay, let's do a little bit of a review. Do you hear me, Don?
I hear you now.
Okay. I don't see myself on the screen, but that's okay. First session was the introduction and the overview, and we talked about that the financial world is a sales world. And one of the things that we're going to learn today is that the sales world is all about bonds. And the bond market is about, I'm going to let Kurt answer it, but I think it's anywhere between 100 to 1,000 times bigger than the stock market. And if you like Michael Lewis's book, he wrote his first book on the bond market that he got out of the University of Princeton. And his first year, he sold bonds and he made kind of $2 to $3 million in that first year. And he didn't know anything about bonds. And then he said, if I can make $2 to $3 million selling bonds and not know anything, then he wrote the book Liar's Poker. So it's going to be a great session today. You need to know this stuff, and it can get very complicated. The second session, we talked about the mutual funds. Annuities are just 2 of the major products that are sold today. Lots of other stuff, but it's a sales world. So 95% of the people who are in the business are selling products, financial products. How you should go about doing it, whether you're doing it for yourself or having somebody help you with it, it's called the financial planning process. So you need to understand your goals. You need to understand your net worth. You need to understand your risk tolerance. You need to understand what assets you own so you can understand diversification. So very important. Medical care planning comes in because we're living longer, and at the end of our life, we may need caregiving services, and which could eat up anywhere from $300,000 to $500,000 of our net worth. So we need to understand liquidity, and that fits right into the bond area as well when it comes to liquidity. Fixed income investing is going to be our speaker today, how to use and understand bonds. So let's go to Kurt's Ask First form.
Okay, Kurt, I'm going to quit sharing and you share your screen.
All right.
And tag, you're it.
Okay, so as we do, we have a blank Ask First form from the first session, and it's on our website. Anytime you're going to talk to someone about your money, use the Ask First form. I use it all the time when trying to get presenters for the program here. So education, what'd you get your master's or other advanced degree in, Kurt?
In finance at the University of Virginia.
Okay.
Economics, undergrad was economics at Claremont McKenna College.
Yeah. So you've been 17 years in the investment business. Talk a little bit about that.
Yeah. So, the investment management industry is broken down really into two different silos, if you will. There's the institutional asset management business, and then there's what they call, wealth management, working with individuals and families. And so the first 8 years of my career, I was on the institutional side. That started at PIMCO and was there for 5 years. And then another manager out of Chicago that actually I was in their San Diego office, and another bond manager. That's a very different business in that you're, a cog on a portfolio management team, a large team managing, billions of dollars for pension plans, endowments, and foundations, things of that, portfolios of that nature. And then I made a shift in my career about 9 years ago, moving to working with individuals and families, which is, you're managing their portfolios, whether it's their retirement accounts or their trust accounts or whatnot, but you're also, heavily involved in financial planning and that type of guidance. So I started here at Buffalo Capital, about 9 years ago, and yeah, so that takes me to where I am today.
You are now the president.
I am working my way up.
Well, I've had a lot of people who have been through PIMCO, and they've all said positive things about their structure and how they manage their money. Would you say the same?
Oh yeah, absolutely. It was a great place to cut my teeth. That was actually I had worked in Manhattan in New York for an equity manager prior, but PIMCO, that was in college, and PIMCO was really my first job out of school, my first 5 years in the industry. And when you don't know any better and that, you get no lunch break, you're in at 6 a.m. and you're leaving when they tell you can leave. And so that type of work ethic that they instill and demand from their people. And then also the exposure you get to just exceptionally bright people. And I mean, Orange County, I think we all know, can be a bit of a bubble at times, but within Newport Beach, on that trading floor that I worked on, you're hearing, many different languages spoken from across the world. So it really does have an international feel, which can be tough to get in this area at times. But yeah, it was wonderful. And their process, is rigorous, and just a ton of exceptionally bright and capable people there.
For a retail customer, for example, if I wanted to get into a PIMCO fund, do they cater to the fee-only fiduciary advisor, or do they cater to the broker, or do they cater to the mutual fund industry? Or should I just look for the PIMCO name, and anything that has PIMCO on it, I should just trust?
Well, it's been an evolution. So that's really it's less about PIMCO. So PIMCO's not going to have any hidden fees or anything. They're very transparent. It's more about the pathway in which you're accessing the investment. So, for a mutual fund, for example, there are going to be various share classes. And I'm guessing I know you had a session on mutual funds, so you probably talked through that a bit, but, if you are working with somebody who's, a salesman or woman and is taking commissions and has a securities license, they can sell you a certain share class of a mutual fund and take a commission on that, and it may have a higher fee baked into it as well. From our perspective, if we were to ever buy a PIMCO fund, which we have from time to time, we would always buy the cheapest share class because we're a fiduciary, and I guess we may get into that on the ask first.
Yeah, exactly. So just don't buy just PIMCO just because of the name PIMCO. Make sure you understand how the fees. You got a 65 license type, which means this is that you're a registered investment advisor through your firm, Buffalo Capital, correct?
Correct.
Right. And then you do not practice law. If you scroll down a little bit, you are a fiduciary at all times. You put your own interest first versus for your clients. Then you pay yourself a salary, and then payment will be made by Buffalo Capital. So, and you own Buffalo Capital, I'm assuming.
Correct. I'm one of two owners.
Yes. So how do you charge your customers? How do you charge your clients?
Percentage of the assets under management.
What is that, Kurt?
Typically 1% if they meet our minimum, which is $250,000. For clients who, exceed certain, asset thresholds, it'll break to under 1%. If, usually you got to get to around, 3-4 million under management to hit those breakpoints.
Okay, and then so it's 1% of assets under management, and then do you pay does the client pay on a quarterly basis?
Correct. Yeah. So it would be, if your fee were 1%, it would be 0.25% each quarter.
Based on the value of the monies held in them. And if they go with you, is there some sort of hey, I tried you, Kurt, and I wanted to leave you. What happens then if I, want to break off the relationship?
Yeah. So as long as you notify us, if, for instance, we predominantly we do some work with Schwab and TD Ameritrade. Predominantly the accounts we manage are at Fidelity, however. So if we're notified by the client that they want to go in a different direction, two things happen. If they're going to say self-manage, we would just pull our name off of the account that we're managing. And at that point, it moves from Fidelity's, Fidelity has the institutional side of their business where they work with advisors, and then they have the retail side where they work directly with clients. The account would just fall over to the retail side once we pull our name off. As far as the fee, if that's maybe what you're asking as well. So we bill quarterly in advance. So at the beginning of the year, we will charge our fee, and let's say it's 1% a year, so 25 basis points for the first quarter, say of 2020. We would have billed that fee probably in the second week of January, and that fee is to cover management service or management fees from January 1 through March 31st. If halfway through the quarter, midway through February, client says, "Hey, I'm going to go in a different direction," we would then mail them a check for the unearned portion of the fee. So if they had paid a $500 management fee in January and they left in mid-February, we would prorate it based on the number of calendar days in the month, in the quarter, and then send them a check for the portion of the unearned management fee.
And so the only way you're paid is by salary and bonus. You don't take any referral fees. You don't take any commissions. The only way you're paid is by the client.
Correct.
Okay. And then you're not associated with anyone who sells annuities, insurance, mutual funds, et cetera, where you get a kickback?
Definitely not. No.
You should wear sunglasses. Then you certified the above is true and correct. Let's get into the program, Kurt. By the way, you need to know this stuff, whomever you hire. Okay, these are questions you should have up front. I hope everybody understood the discussion that we had with custodians. Okay, I don't particularly care for Fidelity as a custodian because they're so big and they sell a lot of other products. So you're going to get hit by other individuals. But Fidelity is completely separate and apart from Kurt's business. So you're going to get statements from Fidelity that Kurt has no control over whatsoever. And so you need to have a custodian that's independent, okay? You don't want to be a Bernie Madoff. Let's get into the program.
Sure. So, okay.
Kurt, because Pete just raised it, I have a question for you. Since Fidelity is holding the accounts, do I get charged a fee from Fidelity, or is all of that wrapped into your fee?
No, yeah, Pete, we can debate Fidelity later, but no. So Fidelity historically would get paid on, if you bought a stock or an ETF, they'd charge, say, anywhere between $5 and $12 transaction fee. Well, all those fees went away. And what they charge for most advisors is on mutual funds, transaction fees is what they still charge. But we have an agreement with them in enough scale that, we don't pay those fees either. So Fidelity, they really don't make any money off of us. It's kind of incredible. They, if you buy, they do some securities lending, and if you own their money market fund, they could make some money there. But their money market fund's also the most competitive. I mean, if you go to TD Ameritrade, their money market fund's going to pay you zero. And maybe they're all paying a lot less now because interest rates are so much lower. But, a year or two ago, Fidelity's money market fund was paying 2% and TD Ameritrade was paying, 0.1. And Schwab was the same. So in our experience, Fidelity, of the big three, Schwab, Fidelity, TD Ameritrade, Fidelity is the only private company owned by the Johnson family. I think they're the largest private company in the U.S. Don't quote me on that, but I believe so. And they, I think that allows them to do things that are a little more client friendly. Now
but Kurt, I agree with you. Fidelity is one of the big three, and I don't think you're going through an advisor such as yourself. Fidelity is absolutely wonderful. So
okay, we've covered Fidelity. Let's go to the presentation.
Okay. So a little bit of what we'll get into today, investing in bonds. So we'll define fixed income as an asset class, talk about the role it plays in your investment portfolio, walk through some of the features and mechanics of individual bonds, talk about the risks of investing in bonds. We'll go through some examples. And then, I'll give my thoughts on how best to go about investing in bonds, and then, make some portfolio recommendations as well. Okay, so what is fixed income? It's, just like people interchangeably say stocks or equities, fixed income is more or less interchangeable with bonds. So fixed income is typically referring to a bond or the bond market. It's a loan to an institution that is obligated to pay you back with interest at a pre-specified future date. We'll later touch on who those institutions may be. But the important part is you're making a loan, you're being paid interest, and then it's set in stone from the time you own that bond when you're paid back your principal, your original investment. The owner of a bond is a creditor or a borrower, if you will, and the issuer of a bond is the debtor or the lender. Excuse me. The owner of the bond is the lender, and the issuer of the bond is the borrower. And so, if you buy Apple stock, it's an important distinction from stocks. If you buy Apple stock, you are an owner in you own a very, very small piece of Apple. And when you buy a bond, Apple also issues bonds. If you buy a bond issued by Apple, you're actually lending Apple money. If you buy a U.S. Treasury bond, you're lending the U.S. government money, which is an important distinction because, as an owner of a stock, you're betting on future growth of the company, right? You're theoretically paying, market value for the current earnings, and you're making, an investment based on the assumption that the earnings are going to grow above and beyond what the market believes, and the price will appreciate. When you buy a bond, you don't need that company to grow. You just need them to stay solvent. You just need them to be able to pay their debts, which is a different proposition. So what role do bonds, fixed income play in the portfolio? A steady source of income is first and foremost. I think that's what a lot of people think of when they think of bonds. They think about income, yield, portfolio diversification. If you think about, Most people start with stocks and then maybe they put in bonds, and maybe there's things like commodities and, other types of investments in the portfolio, real estate. But, bonds is usually typically the first diversifier people go into to diversify away from the stock market. And that's linked to the next bullet there, which is, to hedge against stock market risk. Theoretically, if the stock market is going down, high quality bonds should maintain their value. Second week of March notwithstanding. Now they also, are in the portfolio to reduce volatility, and they do that in two ways. Volatility, by the way, is just a buzzword for the gyrations in your value of your portfolio going up and down. For those of you who are statisticians, it's, pretty much synonymous with standard deviation. And that's as much of an emotional thing as it is, a financial concept. And the reason for that is twofold. One, bonds by nature are a less volatile asset class. And if you think back to what the definition of a bond is, that's because as a stockholder or as a stock, the value of the company is, future earnings is of course going to be, their ability to grow is going to be more volatile than their ability to pay their debts, right? I mean, you have to take a bigger hit to not be able to pay the interest on your debt than you do to not have your earnings grow. You can have negative earnings but still be able to pay the interest on your debt because you've got cash in the bank. And the second way they reduce volatility is they're non-correlated. It's a non-correlated asset. When people talk about non-correlated, they're usually referring to the S&P 500, the stock market. And so the idea is that, if the stock market is zigging, your bonds will zag. And, that will also smooth the volatility in your portfolio. And then lastly, this is something I think is often underappreciated. They're a hedge against inflation. And we've seen that just this year, really the last year and a half. You think about, oftentimes people talk about hedging against inflation. And that's because historically we had different demographics in this country and people experienced what went on in the 70s and the oil embargo. And, they think about inflation and what's an inflation hedge? Hard assets, real estate, right? Things like that, things you can touch. Deflation, which our economy is much more suited towards these days for a variety of factors that I won't get into here. In an inflationary environment, interest rates are typically rising. In a deflationary environment, interest rates are falling. And so when you own fixed income, when you own a bond, it's fixed income. Your yield is fixed. So therefore, if interest rates are falling, the bond that you hold is relatively more attractive now because you're being paid theoretically a higher yield than you could get elsewhere than what the going rate is. So that's why it's a hedge against deflation. You've seen that in the last year as interest rates have declined, bondholders have done well. So some of the key components of any bond are, of course, the issuer. You want to know who you're lending to. That's the issuer. And those issuers receive credit ratings. We'll get into that a bit later. And then you have the coupon payment. There's both, what's the coupon rate and what's the frequency. So if you own a bond that pays a 4% coupon, typically that's going to be paid semi-annually. And so it's going to be 2% every 6 months. If you own a bond fund, they typically kick off the income at the end of each month. So you're getting monthly. So if you buy a bond fund that yields, 3%, you're actually getting, you're getting 75 basis points a quarter. So you're getting probably 0.25% a month is probably what you're getting on that bond fund if it's paying 3% annually. They'll quote you an annual yield, but you'll receive that monthly. And that's because a bond fund will hold a portfolio of thousands of bonds that are all paying their semi-annual coupons at different months. So they always have some that month that are paying the coupon and they're paying out that income to you.
Do you, for your clients, I've heard that some individuals try to set up their retirement plans to where they get a monthly income similar to when they were employed. And so they kind of are used to getting that monthly check. Do you set up a bond portfolio to kind of meet those kinds of demands?
No, because there's not enough yield available anymore for that. Typically, I mean, the pile of cash that you would have to invest to kick off a meaningful level of pure income is
Not feasible.
pretty significant these days. And so what we talk about rather than income is cash flow. And you have to accept that in this day and age, a portion of the yield on your portfolio, if you're retired, and you guys may have walked through already what's an acceptable distribution rate from your portfolio in retirement, and it usually falls somewhere between 4 and 4.5%. And if you have to accept that you're just not going to get very high quality bonds that kick off 4 to 4.5% when the 10-year treasury is at 70 basis points or whatever it is today. So you have to accept that a portion of that return is going to come from capital gains in the stock side of your portfolio. That's the rub. When you're getting less on your bonds, the flip side of that is your equities should be going up in value, because as interest rates decline, stocks typically go up in value for reasons we can get into, but maybe we don't have time today.
Yeah.
But maybe you're going to do it next week when you talk about stocks.
Price,
Yeah. Price, you want to know the price you're paying, right? And this is correlated. This is inversely related to the yield and yield to maturity, which is the last bullet there. So as bond prices go up, yields go down. As prices go down, your yield goes up. And I'll get into a bit later how that works. Maturity date, that's when are you going to be paid back your original investment? That is closely linked to duration, a concept called duration that we'll talk about later as well. And then optionality or call features. This is, typically we're talking about, these would be municipal bonds or high yield bonds that are typically callable. And that's, conceptually very similar to, refinancing your mortgage. It's basically the going rate today is lower. You can refinance at a lower rate. Therefore, you no longer want to pay the rate that you're currently paying. Same thing with municipalities and high yield bonds. Okay, so just like a stock, there's two components of total return for a bond: the income return and the price return. With stocks, most people think about the price return, but there's some income that's delivered via dividends. The flip side, for bonds, the lion's share of your return, particularly if you're buying and holding bonds to maturity, it's going to come from the income. But the price does fluctuate. So all bonds are issued at 100, a price of 100. They all mature at a price of 100. But between the time they're issued and the time they mature, that price moves around. And it can move around for various reasons. If you buy, and so assuming you're not buying the bond the day it's issued, which would be a rare occasion, you're buying it somewhere in the lifetime. So if it's a 10-year bond, you may be buying it 3-4 years into it since it's been issued. If you buy it at a price that's over 100, greater than 100, you're buying it at a premium. If you're buying at a price that's less than 100, that's a discount. If you buy the bond and then hold it to maturity, and it's going to mature at 100, and you bought it at a premium of say 105, from the time you bought the bond until the time it matures, your price return is going to be negative 5%, because you bought it at 105 and it's going to mature at 100. So you paid $105 for the bond and you're going to get 100 back. So right there that you're losing 5%. Why would you do that? Well, that's because you're still going to have a positive return, because the income component, the yield, is greater than that 5%. And that's what gives you a positive yield. And so we'll get into yield to maturity in a bit, but that's what you want to look at, is the yield to maturity figure, because it takes into account both the income return and the price return. The income return, that's the coupon that you're being paid. So if you think about a bond issued at 100 that pays a coupon of 5%, if you bought it that day and held it to maturity, you would make 5% a year. Every year they're paying you 5%. But if you buy it 3 years after it's issued, and you buy it for 105, well, for the next 7 years, it's a 10-year bond, you bought it 3 years later, the next 7 years, over that 7-year period, you're going to lose 5% on the price, because you bought it at 105, it's going to mature at 100. But in the meantime, you're going to have that coupon income coming in. So what is your yield to maturity going to be? Somewhere below 5%, because you're getting that 5% a year in coupon income, but you're also losing a total of 5% on the price that you paid, because you paid a premium.
What I'm hearing you say, Kurt, is that the only way you can compare bond pricing is by yield to maturity?
More or less, yeah.
Okay.
And then the flip side is also true. You can have a bond that has a coupon of 5%, but your yield to maturity could be higher than 5% if you bought it at a discount. Say you bought it at 99. Well, you know you're going to get that 5% yield, but in addition, you're making 1% because you know it's going to mature at 100 and you bought it at 99. So that's going to increase your yield to just above 5%.
Are you going to talk about whether or not individuals should be purchasing individual bonds or a mutual fund?
I am, yeah.
Okay, I'll wait.
That's later. Okay. Talk through some of the risks of investing in bonds. I've highlighted credit risk and interest rate risk because, as Pete just alluded to, at the end, I'm going to recommend that you don't buy individual bonds and that you buy funds. And those are really the two things you should be worrying about. The fund manager should be worrying about the bottom ones, prepayment, reinvestment. I'll talk through what all these are, but you should be thinking about credit risk and interest rate risk. Credit risk is, it's really default risk. It's what's the risk that someone's not going to pay you back. And you're going to lean on if you're looking at a fund, what's the average credit rating of the fund? Or if you go to Morningstar, you can drill in a little deeper. And I would recommend doing this before buying a bond fund. And you can look at the credit ratings. They will rate bonds as AAA, AAA is the highest quality, AA, single A, triple B, double B, all the way on down to D really, and then non-rated. But anything that is triple B or above is considered investment grade. And anything that is double B or below is considered junk or high yield. So that tells you where you are in the credit spectrum, the credit risk. The higher the credit rating, the lower the credit risk.
Does that mean when you purchase a junk bond or a one with a lower credit rating, does that mean that it's a bad investment?
No, I mean, it can be a very good investment as long as they service their debt. You're going to get a higher yield. And I'll walk through an example of how credit affects yield. And then secondly is interest rate risk. And this is, we've got a video we'll play, and this is the concept of duration is closely linked to this, but that's to say the risk that interest rates rise. And so the bond you hold that pays a fixed rate to you is less attractive on a relative basis to the new going rate because interest rates have risen. So those are the two main risks. And you can measure that by looking at duration. So you want to look at what's the credit rating of this bond fund and what is the duration of this bond fund. The higher the duration, the greater the interest rate risk. And we'll get into that in more detail. I'll just run through these. Prepayment risk, that's just the risk, again, of a callable bond of someone calling the bond and paying you. You thought it was a 10-year bond, but it was callable 4 years later. And so you thought you were going to have this nice yield for 10 years. And 4 years later, boom, interest rates have declined and they pay off the bond in 4 years and they refinance. And now you no longer hold that bond and you don't have that yield anymore. Reinvestment risk is you hold a bond, it was paying you 4%, it matures. Say it was Coca-Cola bond, paying you 4%, it matures, you held it for 10 years and you say, that was a good 10-year run. I'd like to buy another Coca-Cola bond, 10-year bond, and do it again. Well, guess what? 10-year Coca-Cola bond now only pays 2%. That's reinvestment risk. So you have to reinvest at a lower rate than you were making. Currency risk is foreign bonds. As you can imagine, you have to buy those in typically in the currency of the country that's issuing the bond. Not always, but usually. Inflation risk is linked to interest rate risk. Typically when inflation goes up, rates rise. And then liquidity risk. And that's just that you have an illiquid bond that doesn't trade very often. So there's just not a lot of demand for it. That's always a risk as well. So most people, when they think about their bond portfolio, questions they're asking are, how can I increase my yield? And there's really only two ways to do that. One is to extend your maturity, right? I said we look at two things, duration and credit risk. So extending maturity, that's by buying a bond with a higher duration. So if you have two, let's say they're very similar bond funds, they're both Treasury bond funds, but one has a higher duration than the other, it's going to pay, because they have the same credit risk, they're both US Treasuries, which is considered risk-free. The one with the higher duration is going to pay a higher yield. And what does that do to you? It increases your interest rate risk. And so that's important to understand. And then with credit quality, the lower your credit quality, that will also increase your yield, but it's going to increase your credit risk, your default risk. And so
for your clients today, Kurt, what is the what's the longest, I guess, maturity that you have for your clients today?
If we buy individual bonds, we buy shorter maturities, 5 years and under. But if we buy bond funds as well, and we'll buy a mixture of different target duration points. It's more about what you wait. I mean, we have some long-term bond funds, absolutely, that have done exceedingly well in this declining rate environment. So we have some, long-term, both on the muni bond side for some of our high net worth clients, as well as on the Treasury side. And, but they're lower weightings. You try and stay closer to what they call the belly of the curve, that intermediate duration, which is the, used to be 4.5 years, but now it's closer to 6 years. And that's because interest rates are lower, and that's related to when rates go down, duration goes up.
Yeah. So for the average individual, if they go beyond 6 years of duration, they need to be very cautious or careful and understand the reasons why they're doing that.
Yeah, and I would recommend probably only do it for a percentage of the bond portfolio. I mean, don't take your entire bond portfolio, especially today, and put it in,
So you would say for someone who's watching this today, they should be looking at their mutual funds if they own bonds in a bond mutual fund, and find out what is that maturity and duration today.
Yeah, and when you look it up, say you're using Morningstar, you're looking for there's a lot of different duration calculations. You want effective, and if they won't give you the effective, you can take the modified duration, but usually you want effective duration.
Okay, so you need to know what you have at the present time.
Yeah, so just take the bond funds, look up their duration, weight them based on the percentage of your portfolio that those funds represent, and add up the totals, and that'll give you your weighted average duration in your portfolio. And if it's greater than 6.5, you might want to shorten duration a bit.
You're taking, in other words, you're taking a lot more risks.
Well, I'll show you the math behind it.
Okay.
So where are we? Slide 8. I lost my numbers here, but let's go real quick. So here's an example of extending duration or maturity. Maturity and duration are very closely linked concepts. This is an example of 2 bonds issued by JP Morgan. So they have the same credit rating, pay the same coupon. Only thing different is they have a different maturity date. You can see the second bond doesn't mature for many, many years, whereas the first bond matures in 2 years. And that's why when you go to the yield to maturity column, it has a higher yield. So you say, great, I'm making 3.7. Why would I buy the one that makes, under 2% when I can buy this higher yielding bond? Well, the reason is because you have greater interest rate risk. And I think Don has a video that he's going to play that will speak to that. So I'm going to stop this and flip it over.
Thank you. And I'm going to play this, and I'm going to do this. Play.
Remember that the value of bonds can fluctuate up and down based on factors such as the movement of interest rates. This is called interest rate risk and warrants some discussion. Interest rate risk affects all bonds, regardless of their credit quality. Let's say you buy a $10,000 bond with a 10% interest rate that pays you $1,000 each year until maturity. Can you sell your bond before its maturity to another investor for the $10,000 you paid for it? Not always. Why? Because you really don't own a $10,000 bond as much as you own a security that pays you $1,000 of interest a year. The annual interest payment and current interest rates on any given day in large part determines what the bond is worth. We're going to oversimplify the pricing of bonds to illustrate how prevailing interest rates determine the price of your bond day to day. Assume that after you buy this $10,000 bond, interest rates drop from 10% to 8%. Not to worry though, your investment was locked in at 10%, so you'll still earn an annual $1,000. But let's say another investor wanted to buy a bond that would also earn them $1,000 annually. How much money would they have to invest at the new interest rate of 8%? $12,500. That means that your $10,000 bond could be worth $12,500 if you chose to sell it, a $2,500 gain. But what if interest rates increase to 12%? How much money will a new investor have to invest at 12% to earn $1,000 annually? $8,333. Now your $10,000 bond is worth almost $1,700 less than you paid for it. Think of a teeter-totter. Sitting on one side of the teeter-totter is interest rates. On the other side is the value of bonds. As interest rates go up, the value of bonds go down. As interest rates go down, the value of bonds go up. You can buy bonds of various maturities. The longer the maturity, the greater the interest rate risk. Think again of the teeter-totter. The closer you are to the middle, the less movement up and down as the teeter-totter swings. The distance from the middle is like the maturities of bonds. Short-term bonds don't fluctuate as much in price given interest rate changes. The longer the maturity of a bond, the greater the fluctuation in price. But what if you don't plan on selling your bond before it becomes due? The day-to-day movement in the price of bonds may be of little concern to the investor who buys an individual bond and holds it to maturity. At maturity, the investor receives the face value of the bond, $10,000 in our example, and has received interest payments in the interim. His bond was protected from the interest rate risk inherent in the market.
Okay, stop sharing that. Back to you, Kurt.
Okay, let me pull this back up. Oh, looks like we're back at page one.
While you're doing that, there's a question that's been asked is holding an individual California muni bond, is holding an individual California muni bond bad? Second part of that is statement showing negative unrealized loss.
Okay, so first, it depends on the bond. If you're referring to a general obligation bond, that should be okay. I mean, the state of California at Prop 8, first third of revenues goes to the schools. After that, the next person who gets paid are the bondholders, and that's the blood of the state's operations. So they're not going to play around with that. So general obligation bond, when you say state of California, then yes. There's other California bonds like tobacco bonds that are backed by the revenues from that settlement. But anyway, so a state California GO I think is safe. The second question was, there's a negative unrealized gain in the bond. What does that mean? That means, if I read that back correctly, that means that
Loss, not gain, loss.
The bond is
unrealized loss.
That's the price return. We talked about. That's the price. So you purchased the bond, say at 105, and now it's trading at 103. So you've lost 2% on the price of that bond since you purchased it. Does not mean you have a negative return on the investment though, because in the meantime, while you've held it, it's been generating income. So if you bought the bond yesterday and now you have a 2% loss on the price, you've probably lost 2%. But if you bought it 5 years ago, the yield you've generated over those 5 years, I'm sure has overwhelmed the 2% loss. So that's just the price return. It does not include the income stream.
Good question.
Yeah. Okay. So that video talked about interest rate risk. And so how do you think about that with your portfolio? So here's an example where you can calculate your interest rate risk. And this is an example of a bond, but this also applies to a bond fund. The same math applies to the bond funds. If you go to Morningstar, look up the bond fund, look at the effective duration, click on the portfolio tab, it'll give you the effective duration. So if interest rates rise 1% and you've got a bond, so let's start with a bond example here up top, or a bond fund, duration of 5 and has a yield to maturity of 3.5%. If interest rates rise 1%, remember, it's a teeter-totter, rates go up 1%, the value of your bond is going to decline. By how much? It's the change in rates times the duration. So if interest rates go up 1%, negative change in rates, because it's inversely related. So if you got a duration of 5 and rates rise 1%, you're going to have the price of that bond fund decline 5%. If you had a bond fund you own with a duration of 10 and interest rates rose 1%, you would have a 10% loss in the price of that bond fund. So that's that increased interest rate risk by increasing duration. Now that's different. The change in price, oftentimes that interest rate rise of 1% will take place over a period of time. That typically doesn't happen in one day. So if it takes place over a period of 12 months, over 1 year, what is your total return on that bond? So if it's a duration of 5 with a yield to maturity of 3.5 and rates rise 1%, you're going to have a 5% loss on the price of the bond, but then you add in, you generated 3.5% in income. So your total return is negative 1.5%. If you had a bond fund with a duration of 10, you would have lost 10% on the price of the bond, but you made 3.5% in income, so you would have lost 6.5% over a 1-year period. The flip side is true. This is the same example of the same bond, but instead interest rates decline. And this is where we get into deflation hedge. Interest rates decline 1%. It's the same formula. Now you've made on a bond fund with a duration of 5, you've made 5%. On a bond fund with a duration of 10, you would have made 10%. And your return over a 1-year period would be that 5% price gain plus your 3.5% yield to maturity for a total return of 8.5%. And this speaks to a concept of being wary of past performance. Let's think of a bond fund with a duration of 10 that has a yield of 3.5. Interest rates decline 1%. Then you made 10% on the price of the bond, went up 10% in value, and you made 3.5% in yield. So you're going to be up 13.5%. This is about to happen because interest rates have fallen so much. People are going to go into Morningstar, look at compare bond fund returns, and see all these bond funds with double-digit returns historically over the last year. And they're going to say, this will happen January of next year. People are going to look back and say, oh my gosh, this bond fund returned 10% in 2020. It's a 10% yield. I'm buying this. Like that, what a great yield. But the reality is 7% of that return may have been generated just because interest rates fell and the prices of the bonds they hold went up, but they only generated 3% yield. So going forward, you're probably not going to get that same interest rate decline. If anything, interest rates are typically mean reverting. So if they move back up, you get that 3% yield, but now instead of getting the 7% price gain the next year, instead of that being repeated, at best it might be flat, meaning you get a 3% return, or at worst, if rates move back up, you could lose 7% on the price. And so now you lose 7% on the price, 3% yield, you've lost 4%. So be wary of past performance with bond funds. It's typically, if it's a really high return on a bond fund the prior year, majority of that typically came from price movement. And on a bond fund, because bonds all mature at 100, even if the price of the bond goes up to $130, when it matures, it's got to get back to 100. That means it has to decline to get back to 100. So we always say price return with bonds is ephemeral. If you're holding to maturity, it comes and it goes. And if you're buying and holding bonds to maturity, over time, 90+% of the return will come from the income, from the yield. So the thing you want to look at when you're forecasting, if I buy this bond fund, what's my return going to be over the next, 5 years? What's my annualized return? It's that yield to maturity number. Don't look at last year's return because that's going to bake in a lot of price action.
Yeah, most people do exactly that. I think they have a name for it, investing in the rearview mirror, seeing what happened prior year, and they have no clue as to the risks that they're taking. And because we're used to looking at CD rates. Okay, this CD term returned X amount. Let me try to get the CD rate similar. Okay, a bond mutual fund is not CDs.
Right.
And you explain that really well.
Thank you. Okay, so that's interest rate risk. And then the other way to increase yield, of course, is dipping down in credit quality. This is an example of a bond issued by Citigroup compared to a bond issued by Verizon. You see they have the same maturity date here, but the Verizon bond is a lower credit rating. BBB is below single A. So because of that, it has a higher yield. They mature at the same time, so they have this roughly the same level of interest rate risk, pretty close to it. But Verizon carries greater credit risk, greater risk of default. Therefore, it's a higher yield. And then let's see. Okay, so if there's no questions there, we'll move into some examples of fixed income that you all may be familiar with. On what we consider cash and cash equivalents would be, anything like a CD in a bank, money market funds, treasury bills. Those are all, what we consider kind of cash-like instruments, which, pay nothing right now, thanks to the Federal Reserve's recent actions. And then under category of bonds, common bonds would be U.S. government bonds issued by, those are treasuries.
So talk about just how our Treasury, why is it important to know what the Treasury rate is?
So all other bonds are what they call spread product, meaning that they trade at a yield higher, U.S. Treasuries are considered to be credit risk free, and we can debate that, particularly with all the stimulus they're issuing, but it's assumed to be the safest instrument in the world. And so all sorts of financial models are built on what they call the risk-free rate, which is the U.S. Treasury bond rate or Treasury note, depending on what maturity you're looking at, but it's considered to be credit risk-free. Therefore, when you purchase a bond that does have credit risk, whether that be a mortgage-backed security or a corporate bond or a muni bond, it's going to yield more than the U.S. government bond. And that's because it's in addition to, for similar duration, because in addition to the interest rate risk that would be the same as the government bond, it's going to have credit risk. And so the spread between the yield on that Treasury bond and that, say, corporate bond, whatever that spread is, that tells you the relative value of a corporate bond versus a Treasury. So all other bond interest rates move based on what Treasury rates do.
Yeah. Becomes very important whether or not you invest in government bonds or treasuries. You need to know the price before you kind of go back into other bonds. Mortgage-backed, asset-backed bonds.
Yeah,
talk a little bit about those.
Yeah, mortgage-backed. I think everyone became a little more familiar with these in 2008. These are mortgage payments that we all make on our mortgages. They are you get into that agreement with the bank, but those are sold off, packaged, and securitized, frequently by Fannie Mae, Freddie Mac, Ginnie Mae, into bonds that are then sold to frequently pension plans, all these bond funds, insurance companies.
Are you looking at any mortgage-backed, asset-backed bonds?
Those are very complex, so we do not buy individual. If we're going to go with an individual bond, it would be a corporate or a muni usually. Treasuries, we can easily do with an ETF. Mortgage-backed, you want to go with a mutual fund. I highly recommend. And then asset-backed is backed by other types of loans. So it's similar structurally to a mortgage-backed bond, except instead of mortgage loans being pooled and securitized, they are credit cards and frequently student loans and auto loans. Corporate bonds, issued by corporations. You have investment grade and then high yield or junk. Investment grade is anything rated triple B or above. So that'd be triple A, double A, single A, and triple B. Once you get to double B, single B, and below, that's high yield or junk bonds. Junk is a name that makes you think you don't want any of this. You just want to be careful. When you buy a bond fund, it's okay that they have, an allocation of 5 to 10% to high yield bonds because there's a higher yield, and theoretically they've done the credit research to understand, whether or not that company is going to be able to service their debt, and they can increase your yield that way. You just don't want to, get out over your skis on those.
If you had, let's say, $1 million portfolio of clients, 70 years old, what percentage, let's say 50% of the portfolio is in bonds. Of that 50%, let's say 500,000. Of that $500,000, give us an example for, would you have 30% in the corporate, high investment grade, or, how do you put together a portfolio for a client using these tools?
Right. So assuming if someone's in a very high tax bracket, you're predominantly going to municipal bonds, but assuming we're talking about somebody who's not in one of the highest tax brackets, then the general baseline is a third, treasuries, securitized, basically predominantly mortgage backed with some asset back, and then corporates, a third. I mean, that's kind of, if you look at the total return bond fund, which is going anywhere in the bond world, that's typically, and the third may not be, it depends if they buy, government bonds issued by foreign countries. But if it's a U.S. government, a U.S. bond, total return bond fund, it's typically going to be around a third is the benchmark, pretty close to that. And then, the bond fund manager may over or underweight based on where they perceive there to be more relative value.
Okay.
So
what are municipal bonds? What are the two types? GOs and revenue?
Yeah, that's kind of, it's really more about in the muni bond, it's what they call the obligor, which is kind of like an issuer of a corporate bond. You have the obligor of the muni bond, which could be, a state, a revenue essential service bond, like sewers and other essential services. And then you have things like, not traditional municipalities, but like hospitals, stadiums are allowed to issue in the tax exempt market. So you want to be careful where you go.
Are you seeing
bonds.
some problems in municipal bonds, city, stadiums, revenue bond area?
Yeah, absolutely. This used to not matter prior to 2008 because there was a AAA insurance wrapper on most muni bonds, meaning that they were insured by somebody else who was taking that risk on. Most of those insurers went under in 2008. And so now suddenly people actually have to do a bit of credit risk, credit analysis. Important thing to understand with muni bonds, they are rated in silos, the credit rating, which is to say all states are rated against one another. All hospitals are rated against one another. For instance, Hoag Hospital has a exceptionally high credit rating, I think higher than the state of California, but it is a riskier bond than the state of California because the state of California is being rated against all of their states and the Hoag is being rated against all of their hospitals. Well, the reality is the state of California, their general obligation bonds, they can both they have the power to raise revenues via higher taxes, which I think we've all seen in this state, and they have the ability to push their expenses down on counties and cities. So that it's just a much more powerful entity to control their ability to service their debt. Whereas a hospital, a hospital is not even a municipality. A hospital functions like a corporate entity. It's based on, there's a P&L there. So, a hospital could be doing great, during, certain periods of time, but they can have a downturn for sure.
Yeah.
Kurt, I want to do Pete, wait, hang on a second. Two things. One, there's a question that on a charitable gift annuity, that really is a fixed income also because it's locked at the time that it was issued by a fixed percent and then will continue as a fixed income for the person's life. So that certainly would be considered as a fixed income instrument.
Yes.
Okay. Second is timing wise, stop asking questions, Pete.
Okay. Thank you.
Go, Kurt.
Okay. I'll
We have a half hour.
Half hour? Okay.
Yeah.
I'll get through this quickly. So we're pretty far through. So
Okay.
Municipal bonds, again, we just covered munis, but the important thing to note there, you'd only want to hold those. I got a slide on munis later, but in taxable, the income is tax free. If you have a capital gain, however, it's not. So if you buy a muni bond at 99 and you sell it at 100, that 1% gain is taxable to you. But the income you earned while you held it is tax free. If it's a California municipal bond, anywhere in the state of California, which is 20% of the overall muni market, it's both federal and state tax free income. And the other thing to understand is that's a very sexy concept and people love the idea of not having to pay the government, but there's an implicit tax on these, and that's because that you have a much lower yield. So they only make sense, what you really analyze with these is what is the taxable equivalent yield? And when you do the math, typically they only make sense for people who are in the highest income tax brackets. And then TIPS are Treasury inflation protected bonds. They're linked to the rate of inflation. So that's an inflation hedge. Convertible bonds.
Are you buying any tips, Kurt?
They're held in some of the bond funds, not individuals.
You're not buying any individual tips?
No. Convertible bond funds convertible bonds. Those are bonds that have the ability to convert to equity. So they're more equity-like on the upside. They pay a lower yield because of that. Then obviously you have international and emerging market bonds. And then you have something called zero coupon bonds, which are a little different animal. So I'll drill into some of the main buckets. First, Treasury bonds typically are going to be anything that's issued that's less than a year maturity is a Treasury bill. Anything that's 2 to 10 years is called a Treasury note. And anything greater than 10 years is called a Treasury bond. But they're all the same. They're all, loans to the U.S. government. It's the most liquid security in the world. There's going to be a lot more of them to pay for all this stimulus that are being issued right now. Pete made a comment earlier about how big is the bond market. The last figure I knew was 100 trillion for the global bond market. That's a figure from I think 2019 from last year. It's going to grow because of the U.S. government deficit. Anyway, They are considered to be credit risk-free. They're not interest rate risk-free. In fact, they carry more interest rate risk because they are lower yielding. And you can buy those directly at that link there. You can actually buy treasuries directly. I don't necessarily recommend it, but if if you're passionate about it and you want to do that, that's a one way to do it. Corporate bonds, again, you're broken up into investment grade and sub-investment grade. Investment grade bonds are going to be higher credit quality, less credit risk. Therefore, they're lower yielding. And because they're lower yielding, they're more sensitive to interest rate risk. And why is that? Think about it. If you have a bond that yields 3% and the 10-year treasury goes from 0.7% today to 2%, that's a big jump relative to the 3% bond you hold. So your bond's going to go down in value. If you hold a bond that yields 9% and the 10-year treasury goes from 0.7% to 2%, it's not such a big deal. You're making 9%. You're still earning a yield far and above the going risk-free rate. That's why high yield or junk bonds are less sensitive to interest rates. So they're riskier. People think of them as risky. They are riskier on the credit side, higher credit risk, but they actually have lower interest rate risk. If
you're going to invest in junk bonds, no more than 10% or 15% of your total bond portfolio.
Yeah. If you're going to do buy and hold junk bonds, the downside risk with junk bonds can be high. I mean, junk bonds were down as an asset class in mid-March. They were down 20% on the year, or from the peak. I think 17% on the year. So that's, in 2008, they were down 32%. So they can have stock market like downside risk, and you don't get quite the upside you get in the stock market. So
be careful.
Yeah, you want to be careful. And they're highly correlated with the stock market. But in good times, in a bull market for the stock market, they're going to get you a much higher yield. But again, percentage of your portfolio, you don't really want to go above 15, probably 10.
That's high.
Yeah, 10. I'd keep it to 5, 10 if you're going buy and hold. I can tell you as a firm, I was talking to Pete before we started this. We don't typically just do pure buy and hold on high yield. We're a little more what they call tactical in that space, meaning that we will move those positions to higher quality bonds or to cash during certain environments, like we had here in March, to avoid the downside risk. So. Mortgage-backed bonds, we talked through a bit of this already. They can either be, thing to note here is they're either agency-backed or non-agency. Agency-backed are going to be much lower yielding because there's a guarantee from the federal government that they're going to bail these agencies out if something happens. So they don't trade with yields that are much higher than treasuries because of that. And then there's non-agency. So these are not backed by the government. So they're riskier, but they have higher yields. And so there's certain bond funds that will specialize in that space. And as I said earlier, determining the underlying credit quality of the mortgage holders, it's a complex process, as we saw in 2008. There've been a lot of books written and a lot of movies made based on what went on there. And the bottom line is, you want to probably leave that to professionals. And in this space, we definitely recommend going active. Okay, so munis, again, income is tax-free. If you're a California resident, you want to stick with California domiciled issuers. Do not buy these in your retirement account because you are already in a tax, friendly environment. That's a tax deferred or tax-free account if it's a Roth IRA. So you're not paying taxes on the gains in those accounts. So you want to buy higher yielding corporate bonds, mortgage bonds. You do not want to buy the lower yielding muni bonds. However, if you are a high net worth individual, or high income earning individual, and you're one of the top tax brackets, your after tax yield will likely be higher with muni bonds than it will be with taxable bonds. Pete talked about general obligation and essential service revenue bonds. Good place to stick to be safe. And the credit, something to notice, the credit ratings here are not as reliable as the corporate. Corporate companies, they have to issue their financials every quarter. So there's a lot more visibility. Municipalities issue them annually in arrears. So it's much more opaque. And with this space, there's yield to maturity, but you also want to look at Most muni bonds are callable. So what is the yield to the date at which they can call the bonds? More important and more accurate reflection of the yield you're going to earn than the yield to maturity, because most of these do not make it to maturity. Because when you have a declining interest rate environment, these people are refinancing all the time. Okay, back to Pete's, probably the big takeaway, buying individual bonds. It's difficult. It's really difficult, not just for individuals. It's, I worked at a firm when I was after PIMCO. We specialized in managing muni bond portfolios for financial advisors, investment advisors, because it's not just difficult for individuals, it's difficult for advisors to do this. Most of them don't have the sophistication to do it. Many of them do it who should not be doing it. And they're doing their clients a disservice. Benefits are, as you saw in that video, you can hold them to maturity. So if you don't want to pay attention to the gyrations of the price of the bond and you just are comfortable they're not going to default, you hold it to maturity and you get your yield and you're going to get the face value back. The drawbacks are the pricing is extremely opaque. It's gotten better. There's some websites you can look at transaction history on, but you go in that transaction history, you'll see the same bond trade from dealer to dealer, which means from professional to professional at a yield of 3%. And then you go see it go from dealer to investor, which means it trades from a professional to, an individual or an investment advisor that doesn't know what they're doing. That same bond that just traded at a yield of 3% will trade at a yield of 1.5% 10 minutes later. I mean, the pricing is extremely difficult to manage. And then, you got to do the individual credit research, which is difficult. And then also achieving diversification is tough because you want to buy bonds typically in 25 to 50,000 lots. And if you want to hold 20 bonds to be diversified, you're talking about you need $500K to $1 million just to invest in bonds. So my recommendations would be, don't be fooled by brokers that are claiming no commission. The commission is baked into the price. So they buy it at a cheaper price, take a spread and sell it to you at a higher price. You can see those spreads when you're buying stocks. When you buy Apple stocks, it shows you the bid and the ask. Those spreads are extremely tight because there's a ton of transparency. You're not going to see someone buy, a stock at 100 and the stock price value doesn't really change. And then the next person buys it at 120. It just doesn't happen because everyone can see the pricing. We get the quotes on our phone every day. You do not get bond price quotes on your phone every day. And so because of the lack of transparency, the lack of an exchange, if you will, like we have with stocks, you see that all the time where the spreads are huge. So a broker may be telling you there's no commission baked in. Well, the reality is they just bought that bond for 100 and they're selling it to you for 110. So they just made 10%. I'm exaggerating. It won't be that wide, but much wider than you would have with stocks. Avoid small bond pieces because they are difficult to sell. It's easy to go buy a $5,000 bond piece. When you go to sell it, you take a haircut in price because they're less liquid. And then recognized quotes are vary greatly from broker to broker. And then if you want to look at past transactions, there's a link for you. Mutual funds and ETFs. This is the route I recommend you go if you're managing your own money. It's easy to achieve diversification. You can buy one total return bond fund and call it a day. You may want to buy two just to diversify managers. I would stick to household names, the BlackRocks and PIMCOs of the world. They're not the only ones. There's plenty of others out there. But, firms that are managing, hundreds of billions of dollars, they have the resources to invest in a deep bench of credit research analysts, which is what it requires to be successful in this space. They're very liquid. You get daily liquidity on them. ETFs are 2-day liquidity. Professional management, again, the credit research. There's a lot of low-cost options. Someone mentioned Vanguard before we got started here. Great low-cost provider. The drawback is there's no guaranteed return of principal. This is where if you have you're not holding an individual bond, so you're relying on the bond manager to trade those. And if you hit a period of volatility and a bunch of your fellow investors in the fund are hitting the sell button, portfolio manager may need to sell some bonds to raise the cash to meet the redemptions. So that can happen. But it's a small price to pay for all the benefits of investing in mutual funds and ETFs on the bond side. My recommendations, first and foremost, particularly mutual funds, you want to know the share class you're buying. You can buy the institutional share class. It's the cheapest. That's what we always buy, but we are able to aggregate and meet minimums for those share classes by aggregating across our entire client base. So you may not be able to do so. It depends on the fund company, but the institutional share class will be cheaper than, say, an A share or a B share or a C share. You want to buy no load commission-free funds. You don't want to pay, some of these funds you buy them, there's a 2 to 5% commission up front.
Yeah. I saw a Franklin fund the other day, and it had a load on it. It had 12B1 funds, 12B1 fee on it. Between the commission and the fee, the customers are getting less for their money than the fund was paying.
Right. Yeah. Yeah. It can take with bonds, it can take years to recover.
Yeah, it's just, and Franklin Templeton is not one of those brand names.
If the end investor understood what was, and that's not, by the way, that's not so much Franklin Templeton as it is the person. There is demand in the marketplace by people, you talked about it up front, Pete, people selling product, salesmen, salespeople who are selling products out there for commission. There's demand for that type of product that pays them the commission. They're not worried about the investor's best interest. They're worried about, their bottom line. So that's why it's there. But
amazing.
Yeah, again, know the manager. And we talked earlier about not chasing recent past performance. That's mutual funds. For ETFs, understand the difference between active and passive. There's a lot more active options now in the ETF space. It used to be predominantly passive. Passive is a great way to go for equities. Not underperforming is an achievement in and of itself in the stock market. There's pockets of, where managers can outperform certainly with stocks. But active is passive is for people do-it-yourselfers is a totally viable way to build wealth in equities. The active space, however, for bonds, I would recommend you go active outside of maybe treasuries. I mean, you can go treasuries, again, there's no credit risk there. So you don't need to go active there. But for bond funds, it's unlike equity fund, unlike stock funds, majority of bond fund managers do outperform their benchmark. And that's, or I should say the ETF that passively tracks their benchmark. Because what you see, sometimes the index looks great, but unlike the S&P 500, where if you buy SPY, the S&P 500 index fund, it's right on top of the S&P. The bond fund, like AGG, is a passive ETF that tracks the US Barclays Aggregate Bond Index, which is the proxy for the bond market. It's the equivalent of the S&P 500 for the bond market. It didn't track so well in March, and that's because AGG actually has to trade in the marketplace, whereas the index does not. So there's frictional costs associated with trading in the bond market that don't exist in the stock market that we just talked about when it comes to pricing. So I'm when it comes to corporate bonds, particularly high yield corporate, definitely munis, avoid the ETFs. You'll see in periods of volatility, ETFs get hit way harder. And here's another thing, conceptually, how is a passive index stock fund built? Well, they weight it based on market cap. So if you buy the S&P 500 index fund, when you invest $1 in that, a greater share of your dollar is going into Apple, Microsoft, Amazon than it is to smaller companies. And that you can justify that. Maybe there's some risk with that, but you can justify that in the sense that maybe these companies have, built a great track record. They've got a dominant position in the marketplace and they're going to continue to outperform. How do you build a passive bond fund? Who gets the highest weighting? It's the biggest issuers of debt. So the biggest debtors become your biggest weighting. So you are investing the most money with the companies that are the most indebted, which means they have the probably lower credit quality and higher risk. So that's why you don't want to go passive. And here's an important concept. When you're investing in the stock market, it's about what you own. It's about what you own. And that's why passive is good, because any given year, it's a concept called skewness. Everyone thinks stock managers underperform because of their fees. They don't. They actually underperform even if they don't charge a fee on average. And the reason is because in any given year, 4 or 5 stocks are the lion's share of the gains in the market. And the chances of them owning all of those stocks is low. And the ones that do, the few of them outperform by quite a bit. In the bond market, it's the opposite. It's asymmetric. So most bonds just hum along and pay their coupons, but you get a few of them that get into real trouble and they may default. And if everything goes well in a bond, you get your yield. If it doesn't go well, you lose all your money. So it's asymmetric risk. So bonds are not about what you own. It's about what you do not own. It's about what you don't own. So you don't want to own everything in a passive index. You want an active manager that is going to sift out the 3% of the bond market that you do not want to own. It'll blow up your portfolio.
Leave the ETFs to the professional.
There you go. Some alternative sources of yield. It's a low interest rate environment. There's obviously dividend paying stocks. Be careful. If the dividend seems too good to be true, it probably is. It's probably because the company's in trouble and the dividend's going to get cut. Preferred stocks.
Dividend paying stocks. I'm seeing a lot of oil stocks now are paying almost 9, 10, 11, 12% based on the drop in price.
Well, so yeah, if you're paying a 5% dividend yield and your stock price gets cut in half, the yield is now 10. So,
Be careful.
Yeah, be careful. It's a good value trap. And then preferred stocks, those are, sometimes issued by banks because they can't issue, they're bond-like, but they can't issue debt because they'll trip up certain covenants that they have. So they'll issue preferred stocks. Those can be sources of yield in your portfolio. The nice thing about preferreds is the dividend income is usually qualified, which means it's taxed at the capital gains rate rather than income tax rate. So those can be a good option to sprinkle into a taxable portfolio. Floating rate bank loans, those are like high yield bonds, low credit quality, but they're actually bank loans. And there's some liquidity risk there. REITs, real estate investment trusts, very interest rate sensitive. They're forced to pay out 90% by law of their income they generate. So this would be a pooled vehicle that owns a bunch of real estate, and you can buy a share in that, just like a mutual fund. It's very interest rate sensitive because one, their value is based on the yield they're paying out. So if interest rates go up, they get hit twice because one, the yield they're paying is less attractive now. And two, these companies are typically, when they're buying properties, they're using leverage to buy the properties. They're not buying them all cash. So their cost of funds is important. So as interest rates go up, their cost of funds goes up. So they get hit. So they're very sensitive to interest rates because they get hit on 2 points.
Please stay away from the private REITs. If you're going to go to a REIT, make sure it's a public REIT traded on one of the exchanges. Or
private REITs are sold for big commissions.
Yeah.
And they blow up more often than
yeah, and very illiquid.
Yeah. MLPs, master limited partnerships, these are, frequently energy related. You look at them, a lot of them have very high yields, but one thing to recognize, their unique structure in the way that the dividends are paid. They're actually not dividends, they're return to capital. So there's some tax issues there. You get a K1, which is not fun for most people. And so there's an extra cost with your CPA. Consult with your tax professional before buying an MLP, and never buy one in a retirement account, only in the taxable, but consult with your CPA before doing that. And then you'll see some closed-end mutual funds. They have, the way you identify those is they're typically only 3 letters instead of most mutual funds. Open-ended mutual funds will have a 5-letter ticker symbol, and the last letter will be an X. But with closed-end funds, it'll be just 3 letters. The thing to note with these is they trade like stocks where they can trade at discounts and premiums, and they use leverage. So the yields will be higher, but they are much more volatile and they are riskier because of the leverage, and because when the market goes down, an open-ended mutual fund will decline in value based on the positions held in the fund. A closed-end mutual fund will decline in value based on the positions they hold in the fund, but then also they can trade at a discount and get hit even more by investors who just who think those are going to go down in the future even more and don't want to hold it. So they can actually separate from the price of the underlying holdings. So it's much more.
Yeah, leave it to the professional on closed-end mutual funds, on master limited partnerships, floating bank loans, and preferred stocks.
I put the closed-end funds there just so you're aware of them, so you don't look at one and say, oh, look at this fund yielding 9%. This is a great yield. I want to buy it. Recognize if it's got 3 letters, CEF or something like this, it's closed-end, there's leverage, and it's elevated risk, and you should stay away. So portfolio recommendations, this first bullet, temper expect. I've been giving this presentation now for probably 5 years, and that first bullet was there the first couple of years. We got to remove it in 2018 and 19, and now it's back because rates are so low again. So temper expectations for yield in the current environment. Was it pigs get fed, hogs get slaughtered, I think is the phrase. Be aware of the duration and credit quality of the securities. The funds you're selecting. What is the credit rating and what is the duration? What is your credit?
Morningstar rates them, correct?
Yes.
Okay, so they can get the duration and the credit quality directly from Morningstar.
Morningstar pulls in the credit ratings, I think, of Moody's, S&P, and Fitch.
Okay.
Yeah, they're not doing their own. I don't believe. And those are the 3 big rating agencies: Moody's, S&P, and Fitch. Invest in a mix of mutual funds, ETFs. There's a couple ways to go about this. I'd probably recommend just buying 2 total return bond funds. If it says core, understand this: does it only hold investment grade bonds, or do they hold some high yield? And usually, if they hold high yield, they also are able to hold emerging market debt, which is similar to high yield in that it's higher yields but elevated risk. And more correlated with the stock market. So if the bond fund says core plus, they typically have a sleeve in there that's high yield. If it just says, if it's just core, it's typically not. But you can drill in, look at the credit ratings and see what they hold. You could take a couple approaches. You could say, I'm going to buy a treasury fund. And that, if you're going to do this, if you're going to break it up into funds by sub-asset class, I'd buy a treasury ETF because it'll be cheaper. And then I'm going to buy a corporate bond fund, buy a mortgage-backed bond fund, which, some good ones for mortgages would be like Double Line Total Return. TCW has a good mortgage fund, so does PIMCO. PIMCO has a good corporate bond fund, so does BlackRock. Or you can just say, I'm going to buy a total return bond fund, rely on the manager to decide whether, how to weight corporate bonds versus treasuries versus mortgage-backed and asset-backed. And if you're going to do that, maybe just buy 2 of them.
It doesn't have to be complex, right?
No, it's a complex asset class, the way they function, much more complicated than equities, but you don't need to make it complicated. In fact, you shouldn't spend too much brain power on your bond portfolio, because the difference between, when I was at PIMCO, we had the competition between the main portfolio managers for who had the best performance that year. And the top performing and the bottom performing would be separated by less than 1%. It's, knocking it out of the park on your bond portfolio, you may add 0.5% return to your bond portfolio. This is here for stability, to reduce volatility in your portfolio so that when, something like COVID-19 happens, you don't freak out and sell all your stocks at the bottom of the market because you've seen your portfolio decline in value so much. These are here for psychological reasons as much as anything. So keep it simple and you'll be fine.
So if you buy a bond fund, it's not going to be near as volatile as the stock fund.
No, gosh, no.
Okay.
No, a fraction.
Okay.
A fraction of it. Diversify, keep an eye on costs, focus on the tax efficiency, and I don't recommend buying individual bonds. If you do, you'd want to ladder the maturities.
My mother loves CDs, so I've talked to her about laddering her CDs. So she gets some at 6 months, a year and a half. Don't go out further than 3 years.
Yeah, that's that solves 2 problems. One is reinvestment risk. So as the ones on the nearer term, the 6-month CD matures, if rates have gone down and you can't reinvest those proceeds at the same rate, you have bonds further back in the ladder or higher up in the ladder that are already taking advantage of those rates. And then so that's your reinvestment risk. And then it also helps for interest rate risk, because if interest rates jump, you've got stuff maturing soon in 6 months that'll be able to take advantage of those higher rates. And even though your CDs on the back of the ladder are, theoretically not doing as well. But yeah, laddering makes sense with CDs. Absolutely.
We have 5 minutes left. Is that correct, Don?
Yes. So there's a question, Kurt, there's a question. Could you review how he said with low interest rates, we accept income won't be great, but bond cash flow is good.
Well, I was actually referring to portfolio cash flow. And so, bonds at this level of yield are as much about, the return you're going to get from them is as likely to be capital gains as it is yield, because the yields are lower, and you have them in your portfolio to balance your stock market risk. If the stock market goes down, the bonds should hold their value or hopefully go up in value, at which point you're making a capital gain. But I think that was a question about income from a portfolio that I was addressing, where, do you build a portfolio? Pete asked, do you ladder bonds to target a yield to replace somebody's income that they had when they retire? And I said, no, because interest rates are lower. So, whatever the cash flow is that an investor needs from their portfolio, or a client needs from their portfolio, we achieve that through a combination of the yield in the bond portfolio, but also you have to accept that you're harvesting some gains from the stock portfolio, because there's just not enough yield in the bond market right now to replace most people's income with whatever their investment balance is.
And capital gain yield is not a bad thing.
No, I always talk about, it's like people are obsessed with income. At the end of the day, if you've got a well, a great analogy is, if you've got a well in the backyard that you're using for water, do you care if it shows up there because of rainfall or snowfall? It's all water, right? So as long as, you shouldn't be, opposed to taking distributions from your portfolio that are from capital gains. I mean, it's all money. It's all income.
The stock does not know you own it. Neither does a bond. So,
Right. Hopefully your advisor does, though.
Yeah.
Okay, Kurt, if you want to go to your next slide, it has your contact information.
Sure.
Thank you. There you go.
Anyone has a question about anything, anything here or their portfolio, want to look at it, I'm happy to take a look, happy to chat with you. Shoot me an email or give me a call.
Okay.
Yeah. Most presenters and most fee-only advisors will give you a free hour and a half, and they'll give you their opinion as to your present portfolio. It's a great thing to do.
Yeah, we don't charge for financial planning anyway. So we don't charge anyone anything unless they've, signed an advisory agreement with us and agreed to move assets. It's not like we're attorneys. You're not going to get a bill.
Good. I thank you, Kurt. We can stick around for a little bit in terms of if there are other questions, but I'm going to stop the recording.